Welcome back. You're watching Stock Watch this week, and joining me to unpack your stock-related questions this afternoon is Gary Booysen from Rand Swiss. Start sending us your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thanks so much for your time, Gary. I don't know, Gary, do you think there is panic in the markets at the moment? And do you think that we should be bracing ourselves for a little bit of a bloodbath?
Maybe. So it definitely feels that way after a week like this.
Yeah.
The week has definitely been bruising. Obviously, with the news of the weekend of the Iranian attack, that's really escalated the risk premium, I suppose, you need to associate it with the Middle East. And that lifts all your expectations around inflation because, there's the potential disruption to oil supplies. And now, today, obviously, we received news that potentially Israel has retaliated, which, just does not help things. And we had the Brent crude oil price now spiking above $90 a barrel. Although it did moderate, towards as we move through it. So it's just sitting kind of around $86 a barrel at the moment. So looking a lot better. But all of this feeding into inflation expectations as well. So the idea that we came into the year and we were going to get 5 rate cuts, and that's amazing because that should send bond markets higher, it should send stock markets higher. Now I think we're down to around 2, which is looking pretty scary. I think we had one of the Fed chiefs coming out and saying that there's a very good chance that there will be no rate cuts from the Fed this year, and that's pretty scary news for any market participant. We also had obviously inflation figures out this week from the Bank of England as well, at least from the UK, and then that feeds into expectations from the Bank of England as well. And they're talking about 1 rate cut this year of 25 basis points. So, any loose monetary policy, any loose monetary policy that we were hoping for that was going to lift stock markets in general is slowly evaporating, and that's leaving us very much with the company fundamentals to deal with. In a very tough environment. So, we've also got the US earnings season starting up at the moment as well. Companies beating expectations, but as we all know, they hike, they tell all the analysts that the earnings are going to be not so good, and then they release better earnings anyway. So I think 90% so far have beaten expectations, but we're really going to get into a busy reporting week next week. I think we've got a massive amount of companies overseas that will be reporting. And we hope earnings seasons are generally positive, but we hope these companies are doing well enough, even in spite of a much more difficult financial environment, if you want to put it that way.
Well, talking about overseas companies with earnings, we did have Netflix out last night. And quite a few things over there, because now they're saying that they are going to stop reporting on their subscriber growth, all those numbers that investors have historically held on to. And now they're saying that we just need to put our focus on revenue and profit and free cash flow. And it looks like they're doing good on those financial metrics. And I'm wondering if, just their decision to stop reporting on their subscriber base is maybe something to worry about, and if it's a signal for a slower kind of period that they are anticipating. What do you make of that?
Well, I think it's maybe a way of explaining it as well, because if you actually look at the underlying numbers, it didn't look too bad. So if you look at the Netflix revenue numbers, 9.37 billion versus the LSEG, which is the old Refinitiv, which is the old Reuters, estimate of 9.28 billion. So beating on the top line. Earnings per share coming in at $5.28. The expectation from the market was $4.52. So a nice beat on the bottom line as well. You look at the total memberships, that was at 269.6 million. That's up from the expected number of 264.2 million. So kind of beating across the board. But the stock price in this was reported just at kind of market close. In aftermarket trade, the stock's down around 5%. So what's going on here? Is it because they're choosing not to change the reporting framework? Maybe, but maybe also investors are just generally concerned about the competition in the streaming industry. So at the moment we've got obviously Canal Plus coming in to buy out MultiChoice and create an African streaming giant. But you look at the likes of Disney Plus, you look at Netflix, you look at what Amazon is doing through Amazon Prime. this is an incredibly competitive space, and you feel that the margins are going to get thinner and thinner and thinner as people almost expect this content for free. So a direct content supplier like Netflix, which is very reliant on that subscription revenue, that poses a concern. If you look at something like Amazon, they don't need subscription. They can run Amazon Prime for free because all they want is the audience. They want it as part of their package deal, so that you're buying through the Amazon store, that you're becoming an Amazon customer, so that you have your Echo and your Kindle, and you've got all these other things that they're servicing. Even Disney Plus. I mean, we see more opportunity in Disney Plus than Netflix because Disney has all the associated merchandise. It's got those franchises. It's not about paying your Disney Plus subscription. It's about getting into the Star Wars universe, getting into the Marvel universe, going and buying toys. You look at something like He-Man. I don't know if you remember this. I'm giving away my age. That whole show that became instrumental to a generation. It helped raise people. Was all just to sell the action figures. So yeah, I think that the whole streaming business, it's a super competitive landscape. And of course, we haven't even talked about the idea of the gaming companies. You look at what gets spent on a movie these days. I mean, you look at something like stick in the mall, Avengers. I think Avengers, their budget was something like $360 million. You look at the new Grand Theft Auto game that's coming out from essentially Rockstar Games through Take-Two Interactive. $2 billion they're spending on making that game. I mean, it absolutely dwarfs movies, and that's a different stream of entertainment. It's another way of competing for people's attention. So I think a difficult environment for these streamers, and they are. I mean, I think Netflix does look, even though it's beating estimates, for us a little bit pricey.
Okay, so maybe a little bit of caution there that investors should supply. It's quite interesting, though, the dynamic that you are seeing there. You're talking about the heavy competition within the streaming services, but I mean, the competition that they're not worried about is Ster-Kinekor. Ster-Kinekor instead is worried about them. So it's quite an interesting dynamic that you are seeing on that front. Let's go on to the questions, Gary. A lot of people have been asking about Sun International this week, and just also linked to the economy, and if there is still optimism on Sun International, and if there is upside expected in the economy to boost Sun International, but also just on their exit in Nigeria. They did have an announcement yesterday that they're selling their stake in TCN Nigeria. And I'm wondering if the prospects just look good, and how good considering the economic backdrop.
Investors usually take an exit from Nigeria as a positive thing. I think back to Tiger Brands and so many other people that have just been burnt. I think if MTN said we've managed to exit Nigeria, you'd probably see the stock price double. But at a reasonable price, of course. But yeah, so that's a good thing. But looking at Sun International, I mean, the stock price recovery has been pretty good, compared to, let's say, something like City Lodge. It's I suppose you look at Sun International, and yes, it is obviously going to be reliant on the economy in South Africa. And I think, I was listening to the CEO speaking just around like as they came out of COVID and what it meant for them just to be able to host conferences again. So you need also, you think of Sun International as, you need gaming when you need, just average people going out and renting accommodation. It also comes down to like an active and vibrant business climate in South Africa, where they go and rent these huge conferences out, at the Lost City, and then everyone moves into the casinos and uses all the facilities. I mean,
and then there's no load shedding for a week.
Exactly, and it's a huge part of the company's business as well. So, without South Africa managing to grow at, like 2-3% growth rates, I mean, the stock is going to be constrained. And if you compare it to something like something that is, something like a Booking.com, or even looking at something like a Royal Caribbean overseas, like the cruise line company, or even we've already been talking about Disney. You think of the parks business within Disney. You've really got to look at it and say these valuations are compelling, and I suppose they are cheaper. I mean, you look at it as trading on a trading 12-month PE of around 8.4 at the moment. It does have a 9% dividend yield. That's great, but that's a 9% rand-based dividend yield as well. And if we see the currency blowing out, that isn't actually protecting you as much as you thought. So, looking at just from a technical basis, like I said, the recovery is pretty sound. It's been kind of like a steady upstream. It looks like a big buyer in the stock to me, just from a technical point of view. That does seem to have broken down over the last couple of weeks. So difficult to tell. I'd say short term, you could probably look at, say, 45 Rand per share.
Yeah.
But yeah, I'd be cautious. I'm probably not diving into Sun International at the moment.
All right. Well, talking about diving, Mtic. This is a share that not a lot of people look at, but it did take a dive in its share price in February after signaling an earnings reduction there. ICT company also, they have green related products there. Is this one that you look at, Gary? Because there is someone that's asking, what's your take on Mtic?
Yeah, so I'm the wrong person to speak to about Mtic. You should be speaking to Anthony Clark. He's the expert on Mtic.
And Alex
so I'm
Days.
looking at his. Yeah, but I mean, and Anthony's really your guy on this. So,
Yeah.
so I mean, his latest research note was 4 days ago. He did a full coverage of Mtic, and currently he says that the stock price is down, reasonably, and currently, he believes the price is now low enough to justify a speculative buy at around 8.99. So that's kind of where he's saying it. He reckons there is an opportunity here, definitely, but yeah, like I said, much better guess than me to speak to the stock.
And talking about speculation,
I can look at the trade flow on Mtic for the day as well. It's going to be super low. Like I say, not one that like really falls on my radar. Just a little bit too small.
All right. So talking about speculation, Barloworld, what have you come up with there? Because there was a really great share price reaction earlier on in the week. They came out with a very colorless cautionary announcement. Is there any color that you've gotten from the market?
Yeah, and again, also not really a stock that I watch. I'm kind of more focused on international stocks these days. But yeah, looking at Barloworld. I mean, obviously with the unbundling heavy machinery, it's a South African industrial stock that is going to rely on at least an improvement in the domestic economy. For that, in a high rate environment, that's always going to be kind of a drag on the overall business. I mean, equipment sales still make up around 86% of the business after obviously the unbundling of Zeda as well. So I think it's a stock that is, again, it's one of these industrials that's linked to the fortunes of South Africa and to an extent the global economy as well. So I would probably be cautious. I mean, again, you're looking at it, it's still trading on a dividend yield of 6% and a PE of 7.68. So yes, if you're a value investor, this is a stock that you should probably be looking at. And I mean, if you're looking at kind of like the South African mid-cap environment, that's what you've got to be. You've got to believe that there's going to be a turnaround at some point for these South African companies, and that these multiples are going to improve. That sentiment around the country is going to improve, because at the moment you might get a great dividend yield, you might be buying a really cheap stock. But the point is, like, you need to, if you want to make real returns in the market, you need that catalyst to propel that stock price higher, to make people believe that this company is worth a 7, 8, 9, 10 times earnings. And without that, you're not going to get the capital appreciation unless they really manage to turn around unless they manage to really improve the other side of the PE ratio, which is the earnings. But again, in the environment that we're in, it's incredibly tough. And I think there's probably more interesting companies overseas.
Well, talking about interesting companies, Gary, what is your stock pick for today? Are you choosing something overseas, since you're saying that your attention now is more that side?
Yeah. So stock pick for today. Let's go. Okay, so I'll go with SLB. So it used to be Schlumberger. It was an oil services company in the I suppose it's multinational. So it's all over the place. It does essentially oil field services. And I think if you look at the big energy stocks, so the likes of Chevron, ExxonMobil, BP, Shell, a lot of them have moved up quite aggressively with the rising oil prices just around the Middle East. Now, people I think have maybe underappreciated what it's now called SLB does. It's an absolute stalwart in the industry, but they look at it and say, oh, it's potentially maybe think that the higher oil price is not going to feed into essentially drilling more wells and all the oil services that they provide. So it hasn't kind of had the same run up that you've seen in a lot of the other stocks. So the fact is, however, that again, if you think that oil is not going to be something that is consumed in the near future, this is probably not the stock for you. But our view is that around ESG and all of that, the opinion swings faster than the actual real demand. So what happens is people stop investing, there's a shortage, and you actually see price spikes. And this you can see throughout history. And then eventually the demand will reduce as we move to more greener technology. We don't have trucks, we have hydrogen powered trucks, or we have battery technology in all our cars. Now that delay, that lag generally results in a price spike that should result in a profit spike for SLB as well. Something that I think you could potentially add to portfolios at this stage, even with the higher oil prices.
All right. Well, thank you so much for your time and for your analysis today, Gary. Much appreciated. That was Gary Booysen from Rand Swiss.